It's tax season, and if you're an investor, there's one tax document you absolutely cannot afford to ignore: the 1099. Today, we're going to answer 3 of the most frequently asked questions about the 1099 tax form and how it impacts investors just like you. Hi, I'm Joseph Eschleman, president of Towerpoint Wealth. We're a leading wealth management firm in the greater Sacramento region. Here at Towerpoint, we believe that tax planning shouldn't just be something you think about during tax season. It should be a year-round philosophy that helps you keep more of your investment returns in your nest egg and minimize your obligation to Uncle Sam. While the 1099 form might seem pretty straightforward, understanding what information is found on your 1099, how to report it, and how to strategically minimize your tax liability can mean the difference between keeping more of your hard-earned money or paying more than you should to the IRS. So let's get right into it with the first frequently asked question about the 1099 form.
What is a 1099 form and why is it important?
Unlike a W-2, which reports your salary and income taxes that are withheld by your employer, a 1099 tax form represents investment-related income, such as dividends from stocks, interest from bonds and savings accounts, and capital gains and losses from buying and selling investments. But here's the key takeaway. Your brokerage firm sends a copy of your 1099 directly to the IRS. So if there's a mistake in how you report this income on your tax return, the IRS will know. And that could mean penalties, an unexpected tax bill, or even an audit. This is why it's so important that you not only understand the 1099 form, but that you have the tools to help you properly report your income when the time comes to file your tax return. Let's see the next question.
What are the types of 1099 forms investors should know?
As an investor, you might receive several different types of 1099 forms. Understanding the differences is critical because not all investment income is taxed the same way. So let's break them down. If you've earned more than $10 in interest from a bank account, corporate bond, REIT, or money market fund, you'll receive an IRS 1099 INT form. Regular savings accounts, CDs, REITs, and corporate bonds are all taxed as what is known as your ordinary income rate, meaning the higher your tax bracket, the more that you'll owe. Tax-exempt interest, like that earned from a municipal bond, is federally tax-free and usually state tax-free as well. Interest earned from a treasury bond, on the other hand, is exempt from state and local taxes but still taxable at the federal level. If you've received $10 or more in dividends from stocks, ETFs, or mutual funds, you'll get a 1099 DIV form. However, not all dividends are taxed equally. What are known as qualified dividends are taxed at lower capital gains rates, usually 15% at the federal level, which is a huge tax advantage, while non-qualified dividends are taxed at higher ordinary income rates. So if you're investing for tax efficiency, holding dividend-paying investments in tax-advantaged accounts like IRAs, Roth IRAs, or 401ks can significantly reduce your overall tax liability. The third type of 1099 form that investors should be aware of is the IRS 1099-B form. If you sold stocks, ETFs, mutual funds, or any investment, you'll receive a 1099-B form, which details the price that you sold an asset for, your cost basis, or what you originally paid, and whether it was a short-term or long-term gain or loss. So why does this matter? Short-term capital gains, which are assets held for a year or less, are taxed at ordinary income rates, which could be as high as 37% at the federal level. On the other hand, long-term capital gains, which are held for more than a year, qualify for lower tax rates, oftentimes 15%. Utilizing this information can allow investors to take advantage of tax-efficient strategies like tax loss harvesting to manage their overall tax liability, offsetting gains with losses, which might allow you to potentially keep more of your overall investment return. Finally, we have the IRS 1099 MISC form. This one may be less applicable to certain investors, but if you earn money from rental properties, royalties, or alternative investments, you might receive a 1099 MISC. It's critical to follow the IRS 1099 MISC form instructions to avoid having this income be taxed as self-employment income. Now, let's talk about some common mistakes that investors should avoid when it comes to reporting their 1099 income. One big mistake is ignoring cost basis adjustments on your 1099-B. Your brokerage firm might not always provide complete cost basis information, especially for investments that you've held for a long time. If you don't have accurate records of what you originally paid for an investment, you could end up overpaying on capital gains taxes. So work with your financial and tax advisors to discuss how to best report investments that you've sold where you don't know the original cost basis. Another common issue is forgetting about reinvested dividends. Many investors automatically reinvest dividends into buying additional shares, which is a great way to compound and grow wealth over time. But here's the catch. Even if you reinvest them, dividends are still taxable in the year they're received. If you don't report them correctly, you could face penalties or a higher than expected overall tax bill. Next, let's talk about the wash sale rule. If you sell an investment at a loss and then buy the exact same position back within 30 days, the IRS won't let you claim the loss for tax purposes. This rule is meant to prevent investors from selling just to create a tax deduction while still holding and owning the same investment. But if you don't pay attention to this timing, you might think you're getting a tax break when, in reality, the IRS is going to disagree. Another mistake is not planning for tax withholding. Unlike W-2 wages, investment income and capital gains that are reported on 1099s does not have taxes automatically withheld. This means if you've received significant dividends, interest, or capital gains in your accounts, you may owe more than expected when you file your tax return. To avoid an unexpected tax bill, consider making estimated tax payments throughout the year or adjusting your withholdings elsewhere. Finally, many investors overlook state tax implications. Not factoring in state taxes can lead to underpayment penalties or other surprises when you file your return. So at the end of the day, small errors on your 1099 forms can turn into costly tax mistakes and possible undue scrutiny from the IRS and state taxing authorities. That's why it's so important to review your forms carefully, keep detailed records, and work closely with a financial advisor and tax professional to ensure you're making the most of your investment income while staying fully compliant with IRS rules. So let's hear the next question.
How can investors reduce taxes on 1099 investment income?
Nobody likes paying more in taxes than they have to, and when it comes to investment income, a little planning can go a long way. Here are a few simple but effective ways to reduce your tax burden on your 1099 income. First, hold interest-producing and dividend-paying investments in tax-advantaged accounts like IRAs or 401ks. This allows your investments to grow without being taxed annually, as income earned in retirement accounts like these is completely tax-deferred. Next, consider tax loss harvesting. So if you have an investment that has declined in value, strategically selling that can offset current year and potential future year capital gains, lowering your taxable income. Again, be careful about the wash sale rule when you do this. Another smart strategy is timing your asset sales carefully. If you hold an investment for at least 1 year, it qualifies for long-term capital gains tax rates, which, as discussed earlier, are significantly lower than short-term rates. Finally, charitable giving can also help reduce your tax burden. Instead of selling stocks and then paying capital gains taxes, instead donate appreciated securities directly to your charity of choice. You may be entitled to a tax deduction for the full market value if you itemize on your tax return, and neither you nor the charity pays any taxes on the gains when the investment is sold by the charity. The key to managing the liability from your 1099 income is proactive planning. The right strategies can keep more of your investment returns in your pocket, not the IRS's. By knowing what's on your 1099, avoiding tax pitfalls, and using proactive tax strategies, you can minimize your tax liability and keep more of your money working for you. At Towerpoint Wealth, we specialize in helping investors just like you maximize tax efficiency and help you reduce your obligation to the IRS. So if you want to take a smarter approach to your investments and tax optimization, schedule a consultation with our team today. And don't forget to hit the thumbs up button if you've enjoyed this video and the subscribe button for our Towerpoint Wealth YouTube channel, as we regularly produce timely educational videos just like this. Remember, our singular objective here at Towerpoint Wealth is to help you remove the hassle of properly coordinating all of your financial affairs so you can live a happier life and enjoy retirement. Thank you for watching, and we'll see you in the next video.